Treasuries may be gaining today, but that's no reason to be a buyer, according to our next guest. Janis is the lead manager for the $3.1 billion John Hancock Strategic Income Fund, which Bloomberg ranks among the top performing global bond funds for 1, 3, and 5 years. The fund, by the way, does not own any treasuries and holds a slight short treasury position. It has no Eurozone government debt, preferring instead to own Asian government bonds and high-yield corporate debt. So that's his position. He joins us now from Boston. Danny, good to have you here with us. Anything that Mr. Bernanke said yesterday or in the Beige book, as Julie talked about, and we're looking at what's going on in Treasuries, anything to kind of change your mind here about the Treasury trade?
No, I don't think so. When I look at it, I think the situation is, as expected, maybe a slow patch, which I think we're going through. And I think if you read some of the details, it said this could be temporary and maybe down the road we may see a pickup. So I think it's a slow patch. The market, I think, is overreacted, and we're still going to stay with embracing credit risk through high yield and emerging markets and some currency situation and shunning our interest rate risk with a lower duration, roughly around 4.
Now, you know, your fund, as we mentioned, has been avoiding U.S. Treasuries as well as the Eurozone government bonds. It hasn't hurt your performance. I'm just curious what it would take to get you back into the Treasury trade.
Well, I think we have to look at the employment situation, and I think Bernanke alluded to that. He's watching that closely to get his assessment. We need to see 4 or 5 numbers, you know, hopefully better. If they turn out to be worse, then maybe we may have to reassess our position. But that would be, you know, over the next 4 or 5 months. We actually think that those numbers will improve. As in 2004, I think the numbers on the jobless claims at 350, and at the employment numbers on the non-farm, roughly over 300, that would maybe get him to change his tone. Right now, we're not there, but we think we gravitate there over the course of the next 6 to 9 months.
Now, Danny, I mentioned you guys do have a great long-term track record here, but I did look at the year-to-date numbers, and you're in about the 45th percentile, so more than half of your peers are doing better. Does it worry you? Does it make you want to change your strategy at all?
No, it was just a short-term move. I mean, we're short the 10-year, so that hurt us a little bit in some of the currency situations in the short run where you had a flight away from some of the commodity in Asia. But I think that's just temporary. It seems to us at certain points in time, if you stick to your guns, when you have the view that the glass is half full, I think it worked out very well last year. I think it will work out very well this year.
Hey, you know, Daniel, you talk about the glass being half full or half empty. A lot of the guys down on the floor here at the New York Stock Exchange are saying there's no plan. There's nothing we can get behind. There's no plan to reduce jobs or to increase jobs. There's no plan to reduce the deficit. When are we going to get a plan? When are we going to get something to get excited about that gets people behind stocks and this economy?
Well, I think our biggest concern, and I've had this concern probably for about 6.5 months now, is you know, whether we have a defined plan on how we reduce the deficit. As you know, in countries that have, you know, spending that's out of control, they become poster childs for emerging market sort of situations where your currency loses value and your credibility as central bank, you know, gets diminished. I don't think we're there, but that scenario 2 or 3 years from now could be a problem if we don't get a path. We need to have the politicians and the powers that be have a sort of direction or path to get there. It probably won't be solved in the next 2 or 3 years, but as long as we have a path that's credible and that the investing community believes in, I think then we have a situation where you can embrace risk a little bit more comfortably.
But not oh, I'm sorry, Adam, please go.
Oh, thanks, Carol. It sounds like until we get that plan, and it could be a couple of years, you're not going to touch government securities. You're going offshore to try to make your money. Is that right?
Yeah, we think that right now it makes sense to look at, you know, a higher risk profile, whether it be in a diversified risk profile in high yield and in some of the EM locations, where we're getting roughly 7% on our high yield allocations. And even in slow growth, they should perform where you clip the coupon. The emerging market situation, as you know, I think your previous guest alluded to the domestic demand increasing. As those economies go from export-led to domestic-led, which we think is a structural positive situation there, you're going to have 2 things happen when you have structural positives. Currency strengthen and interest rates go up, or a combination of both. And I think we want to play some of the currency situations there in Asia.
Danny, thank you so much. Danny Janis of John Hancock Funds.